A lot of interesting things to get through this week. Let's start with CPI. That sort of changed the tone in the market, and bonds had a nice rally. I've got the seasonally adjusted indexes on the screen for headline, core, super core, and shelter. Let's have a look at our trends for headline. 0.3 increased to 0.442, dropped to 0.378, dropped again to 0.313. So you've had 2 months in a row where it has been coming down. The core had a really nice drop as well. 358, 359 was going sideways here for 2 months. And then our last reading for the month of April, 0.292, below 0.3 on the core. If we look at super core, we're 0.221. We've gone from 0.3 down to 0.221. Shelter 0.469. That is a problem. Well, I shouldn't say it's a problem. It's a mathematical problem. It's not a problem in reality. BlackRock, Rick Reeder. Fed needs to lower rates to keep reducing inflation. His argument is based on a transfer of wealth from those who owe money to those who are holding the loans. And because of that, they would tend to spend more. I'm not on board on that argument. I like JP Morgan's argument better. Lower rates are needed for any meaningful downward pressure on shelter inflation. At lower rates, home builders would build spec homes and would bring more supply onto the market, which would put pressure on housing prices. If you look at the house pricing index in Case-Shiller, we're sitting just below all-time highs on those indexes that were set in October, sitting just below it in terms of the price of houses. So if you want to cap that, make sure it doesn't go any higher, or even in some areas start putting downward pressure on it, you have to build more houses. With the high cost of interest at this point, all the home builders have basically said, we're not building spec homes, we're building homes to order. Let's look at Redfin. Median rents for April, 1,648. We'll look at their May 17 report shortly. But they have much faster data. They have real-time data. Look at national. This is their rent index nationally. It's up 1% year over year. The data in CPI works with a lag. So the Fed points out, or the FOMC and Powell points out, that those lags will wear off over time. Well, then this is just a mathematical anomaly. This is the reality, 1%. So when you combine your supercore with this faster data, job done. Higher interest rates at this point can only hurt. And as JP Morgan says, and I've been saying for a while, higher interest rates really just keep the supply of houses off the market and actually make housing inflation even worse. If we look at some of these lines here, you have Austin up here and you have Jacksonville, Texas and Florida. We look at ABR. ABR makes bridge loans to entrepreneurs who are investing in transitional multifamily housing. We look at geographical concentration of their loans. Texas 23%, Florida 17%, roughly 40% coming from regions that have rents under pressure, under significant pressure. Why am I not concerned? 2 reasons. Is the nature of the target properties. These are transitional housing. So you're looking at Class C, maybe low B minus, where the units are in definite need of upgrading, and same with the tenants. You might have 60-70% occupancy with maybe only 50% economic occupancy, meaning only 50% are paying the rent. So you're going to invest in the property and upscale the tenant. These rents were, if market rents are up here, these rents are down here. So even if market rents are falling, these rents are still going to increase. And the occupancy is going to increase and the cash flow of the properties are going to increase. Maybe not to the point of the great projections that these entrepreneurs might have had in 2020, 2021. However, look at what's been going on. Look at the dates down here. This is late 21, early 2020, 22, and you've had rents that have been coming down while you've had interest rates that are going up, and ABR is still standing. If you are not a fan of their net income, thinking, well, you can manufacture net income, they're modifying loans, they're not writing them off. Well, wouldn't you do that? Somebody owed you 20 bucks and they didn't have the 20 bucks. Would you say, okay, I'll just write it off? Or would you say, well, okay, well, what do you have? Do you have at least 2 bucks? Okay, give me 2 bucks now and we'll extend the 18 for a week. You're going to do what you can, right? Well, that's what they do. Their loan modifications came with capital calls. Good enough. But again, if you don't like the net income because you're concerned they're not taking enough charges, have a look at their cash flow statement. Charge-off doesn't affect cash flow. Cash either shows up or it doesn't, especially for a financially based company like ABR. Cash either shows up or it doesn't, and it still has positive cash flow from operations. After, at this point in time, after this increase in interest rates and this decrease in rents, they're still standing. With this exposure to the 2 worst geographical regions in terms of rent direction. So if you can get through all of that, and we have the possibility of rate cuts, the real possibility of rate cuts this year, starting this year, why throw in the towel at this point? Now, I don't believe that Arbor is a $20 stock today, but I also don't believe it's a $10 stock. I'll talk more about Arbor coming up. Let's have a look at the May 17 report. Okay, published May 17th, 2024. The Sun Belt is seeing some of the biggest rent declines in America. 9 of the 10 metros facing the steepest drops in asking rents are in the Sun Belt. The exception is Seattle, where rents fell 7% year over year in April. The biggest decline among the metros Redfin analyzed. Nationwide, the median asking rent rose 1%. So we can head right down to this metro level summary. And we have a number of metro areas here, I think 36. And you can look at year over year. Let's just order it in terms of the biggest drops. There's Seattle, Austin, Nashville, Jacksonville, Miami, San Diego, Phoenix, North Carolina, Charlotte, Tampa, Orlando. So you can see a big exposure to Florida and Texas in here. So when I saw this, I thought, well, let's just check what ABR has, 40% to those areas. Now, this is not a forecast. It's not saying rents will drop. It's saying rents have dropped, and we've already seen ABR's Q1 earnings. This is rear view mirror information. So that's why I'm not too concerned about ABR, that if they were going to have significant trouble, they would have had it. They would have had it by now. Not saying that they're not in a challenging environment. They are in a challenging environment. And so that book value per share is, I think, an important thing to look at. And for Arbor, the question is, do they deserve to trade at a premium to book value per share in this environment or at a discount? That's really the only question we need to ask. But this gives you an idea of where rents are going. There is nationally 1.1%, 1,648. You can see which of the areas are above. So this is Redfin. To get to it, you can just Google the title of this. I Google Redfin Rent Index, and you'll get to their site. And I think it's the first link which gives you this one. Actually, let's do it even easier. I do this all the time. The link for this is in the description box. I think it's important to also talk about GameStop, or the return of the short squeeze, the meme trade on short squeezes, because a whole bunch of stocks that had large short interest went up, including ABR. But I recognized it for what it was, and I will explain what I did on ABR, but I'm out, and I'm actually short. I'll explain why when I get there. So Keith Gill, who by the way is a charter holder, also known as Roaring Kitty, posted a picture on social media that suggested that he was getting back into the game, and GameStop jumped on Monday, and then tried to follow through aggressively on Tuesday, and then pretty much all week long, anybody who was hoping for some gains were handed losses, because it's not the same story. Very rarely can you repeat something from the past. You can make it rhyme, but you can't make it repeat. The short interest just wasn't the same, and we had seen this game before, so it just didn't play out. I certainly hope that none of you got swept up in this and spent money on call options thinking they were going to continue to explode. You would have lost a lot of money. What happens when something like this occurs is implied volatility spikes super high, so that the premiums on everything become really expensive. Almost the same price for every single call. You're going to pay significant amount of money for each call because implied volatility is so high. If it doesn't pan out, the first thing that happens, even if this goes sideways for a while, is implied volatility crushes and you lose a lot on the calls, even if the price doesn't really decline. So by this time the next day, when the price was pretty much the same and the calls had deflated significantly, you were probably wondering, how come I'm not making any money? And then Delta finished you off. You would have had to had some experience with volatility and with events like this to recognize that the opportunity was to go against the crowd on this one. A couple other things I want to point out before I go to the next screen here. Bloomberg Originals. You can find this on YouTube. The Trading Guru and his money-losing disciples. I watched this and I was stunned at the number of subscribers that this guy had. Something like 600,000, 600, or maybe it was more than that. But it was huge, and it was almost like a cult, really. But I do recommend you watch it. 8 minutes 41 seconds. And it was just the promise of easy money. It was the promise that if you just followed along and you did what we said, you're going to make money. That just doesn't work. Another thing I found interesting, Morningstar, the ARK family of ETFs tops the list for value destruction over the last 10 years. $14.3 billion in shareholder value. Number 2 on the list, second place was Crane Shares. A destruction of 6.5 billion. And I do watch some podcasts, financial podcasts from time to time here and there, and there are a couple that are sponsored by Crane Shares. I just find it interesting. 6.5 billion lost. ARK, 14.3 billion, and that they still exist. They still advertise and they still bring people in, even with this kind of destruction. Kramer has a show, and if you follow his picks, he is mostly wrong. I find it odd and interesting that you can have that kind of track record and still be in existence. Because I think that if I was 80% wrong, I don't think anyone would listen to me anymore. I don't think anyone would find anything I say of any value. So I'm really confused as to why this continually happens. But there's a lot of research that's done around this very thing. Let's have a look at some of that. Okay, I know it's a busy screen, but I'll read through it with you here. I don't confuse day traders with serious investors. And this is a Princeton professor. He's the author of A Random Walk Down Wall Street. Wrote in a blog for Wealthfront, where he's chief investment officer. Serious investing involves broad diversification, rebalancing, active tax management, avoiding market timing, staying the course, and the use of investment instruments such as ETFs with rock bottom fees. Don't be misled with false claims of easy profits from day trading. Backing him up is a large body of academic studies going back 20 years that consistently shows day traders and other very active traders have difficulty making money over anything more than a short period of time. Most recent study, attention-induced trading and returns, evidence from Robinhood users. And I think this is it right here, attention-induced trading. The reason Kramer still exists is because he is on TV. And he does have a following, because he does get attention, and it does lead to trading, the Kramer effect. And I think that some of these bigger losses, like the GameStop, that attracts a lot of attention. This trading guru and his cult attracts a lot of attention. And when you combine this promise of easy money with attention grabbing, it's that constellation right there that becomes dangerous for people's wealth. Attention-induced trading and returns, evidence from Robinhood users, published in October, examined trading activity of Robinhood from May 2018 to August 13, 2020, particularly studied extreme herding events where Robinhood traders crowded into particular stocks. And the conclusion was it's just a bunch of inexperience. We argue that the combination of simplified information display, there's where I get your attention, and inexperience exacerbate attention-driven buying by Robinhood users. Heightened attention-driven buying leads to more concentrated trading by Robinhood users than other retail investors and contributes to buy-side herding events that are usually followed by negative returns. For example, the top 0.5% of stocks bought by Robinhood users each day experienced negative average returns of approximately 5% over the next month. More extreme herding events are followed by negative average returns of almost 20%. I don't know how Robinhood handled GameStop earlier in the week because I don't use Robinhood, so I don't know if any of you are Robinhood users. Was there something directing you to it? Was there a highlight screen where it says, "Hey, this is the one that's going today. This is what you need to get in on"? I don't know. Some other quotes here. The reason why 90%, and this number here, I've seen it as high as 95%. The reason why 90% of retail traders fail is that they all think, trade, and gamble the same way. It is a harsh statistic, but it is very, very true. Not many retail traders last longer than 6 months as they do not understand this game at all. That's fairly common number too, 6 months. There's a reason why day trading is called day fading, because most of them fade away. They lose their money. Another reason why day traders tend to lose money is that it's very different from long-term investing. While traders take advantage of price swings, which means they have to make specific predictions, investors tend to buy a diversified basket of assets for the long haul. One of the biggest reasons traders lose money is a lack of knowledge and education. Same thing down here. Many people are drawn to trading because they believe it's a way to make quick money without investing much time or effort. I want you to think about that. Hey, listen, here's a way to make a lot of money without putting a lot of time in. Do you really think that's true? And if it were true, everybody would be doing it. And if everybody would be doing it, it would no longer exist. There are no shortcuts. Look, neurosurgeons make a lot of money. Why don't you do that? I think many of you would say, well, I don't know how. I don't have the education for that. Well, dentists make a lot of money. Why don't you do that? Well, again, I don't have the education for that. Well, hedge fund managers make a lot of money. Why don't you do that? Hey, yeah, I guess I could do that. Where's the, hang on, I don't have the education for that. If you think it's that easy, why not just go to a hospital and say, listen, I can operate on brains. I can operate on hearts. Or just open a practice and say, look, you got a problem with your teeth. I can do it. Lots of people do it. I can do it. We recognize in almost every domain that we can't do it because we don't have the experience or the knowledge. But when it comes to this game, because the casino doors are open, and that's how it's viewed, you can open a brokerage account. There's nothing stopping anybody from doing it. But there is this idea that, well, it's going to be easy. I can do it. And after 3 months, especially if you're riding a bull market wave and you're making money here and there, maybe not in the most efficient way, but you're making money. You think, I got this all figured out. This is what I'm going to do, because early wins are addicting. But typically what happens is that you make money, and then you blow up. And then you think, oh, well, it's because I didn't have enough money. I couldn't stay in the game. So you get some more money, and you make money, and you blow up. And you'll do that a number of times. And the amount of money you'll lose. All because you thought that you could operate on brains without the 6 or 7 years of education necessary to get it done. There is nothing different in this game. It is a brutal game. If you don't take the time, you're going to lose. These numbers don't lie. 90%, 6 months, they're broke. They believe it's a quick way to make money without investing much time or effort. However, this is a dangerous misconception that often leads to losses. The evidence is so overwhelming on this that, go back to the previous screen with this trading guru who he was making like 60 million a year off this. I look at that and I think, how is this possible? And they were interviewing in this 8-minute thing. They interviewed a few of the people who were involved who were just saying, look, we have nothing but losses. Still in the game. ARC, the leader in value destruction over the last 10 years. Crane shares, number 2, still in the game. It surprises me to no end that the answer is so simple and clear. Education, experience. Education, experience, and you repeat that endlessly. Okay, getting to the heart of the matter. Money market rates still all well behaved, and capital market rates a bullish move over the last week. Curve inversion still exists, negative 41 on the 2-year to the 10-year. Started the year at 35, 669 days now. The 3-month to the 10-year, 552 days, 104 basis points. Canada, deeply inverted as well. I think Canada's next meeting is a cut. Balance sheet, down 49 billion, a net runoff of almost 18 billion because the SOMA ran off 31 billion, now sitting at 6.747 trillion. Money market funds increased 16.36 billion, both on retail and institutional. Government increased for both. Prime, one increase, one decrease, 6.05 trillion. And the arguments of there's a lot of money on the sidelines are right back again. Looking at the news this weekend, everybody's bullish. Everybody's bullish. Every news story of how many markets are hitting new highs. We have a global bull market. Commodities are in a bull market. These things are breaking out. Bread is increasing. Oh my God, up we go. And the usual explanations of why we can go higher have been trotted out. Hedge funds are underperforming their index. There's a lot of money on the sidelines. It's kind of like a real estate agent who tells you no matter what is going on, it's never been a better time to be a buyer. Anybody shopping for a home? Has any real estate agent told you that no matter what you're doing, looking at something saying it's never been a better time to be a buyer? Well, there's a lot of money on the sidelines. Yes, there is 6.05 trillion in money market funds. But we have to make a distinction between money in money market funds and money on the sidelines. There is nothing about that number that says it's sitting on the sidelines. If you look at corporations, you look at cash and cash equivalents. Well, what are cash equivalents? Those are money market assets. And we have corporations with, right now, based on earnings, record earnings. Record earnings mean record cash flows. Record cash flows mean record levels of cash. Well, where are they going to keep it all? Berkshire already told us they got 189 billion. Where are they going to keep it? They keep it in money market funds. So if you have a rise in corporate cash, you're going to have a rise in money market funds. So that does not mean that that money is ready to be deployed into the equity market to push it higher. It's not on the sidelines. It's in its home. It lives in that home. Yet I'm sure you're going to hear the argument, there's a lot of money, there's $6 trillion of money market funds sitting on the sidelines. It's not the sidelines. It is the home. It is their home. It's not on the sidelines. So I would not accept that statement as saying, oh, another $6 trillion is going to come into the market. We've rallied $12 trillion in the U.S., rallied $12 trillion from the October lows, $12 trillion. You think, well, another six, we can keep on running for a while. Careful, that's six. There's nothing there. There's nothing about that six that says it belongs to the equity market. Okay, June 12th, FOMC, 24 days away. Let's point out that we are getting a new summary of economic projections for the June meeting. Will we see 3 rate cuts still priced in or penciled in, or will it be drawn back to 2? Fed Fund Futures seems to suggest it will be 2. Get the minutes in 3 days. Canadian CPI in 2 days. Durable goods for the U.S. in 5 days. Odds are increasing for a 25 basis point cut, 3.5% up to 8.9% now. I don't know. June, I don't know. I'm probably more than 8.9%, but the weight of my probability would still be on 0, but more than 8.9% at this point. Let me see what the minutes say, and let's see how the next few weeks unfold. Going out to December, 0 or only 1 rate cut was 47%. That probability has dropped to 42. There's more probability on 2 or more rate cuts. Having 3 or more went from 2.5 to 3.5%. Nothing much to talk about there, but I think the market is sort of getting it, that we're going to have more than 1 rate cut. 2 to 3 rate cuts, maybe more, but 3 I think is the right number. Effective federal funds rate still sitting at 5.33. Reverse repos dropped by 37 billion. TGA down to 706 billion, a drop of 110. Reserves increased by 85 billion. So reverse repo plus reserves minus 2.5 trillion, which is my guess of where ample is, 1.36. 40 billion runoff per month. 3 years, 34 months. I don't think there's anything exciting to see here, unless your reverse repo really accelerates to the downside. It's been hugging the 400 to 500 billion range for 5, 6, 7 weeks now. Lots of speakers. Sunday you have Powell. By the way, COVID. The guy's got COVID, so he was going to deliver a commencement speech. He's going to do that remotely. Monday, Bostic speaking twice, Barr, Waller, Jefferson. Tuesday, everybody with a mouth is talking. Krosner, Barkin, Waller, Williams. Bostic again twice. Barr, Collins, Mester, and, not wanting to be left out, the Treasury is going to jump in on it too, Yellen. Thursday is Bostic. Friday is Waller. Real yields pulling back, but all still over 2%. Break-even rates dropping just a bit. The Fed Funds Futures, not much excitement week over week. Pricing in 43.5 basis points of cuts versus 42 the week before versus 75 from the last summary of economic projections. Does this come down to 50, or does the market move up to 75? I still think being long Fed Funds Futures for December or January still makes sense. TLT had a good week, up 1.41%. SPX up 1.54%. No implied volatility on TLT, the lowest in over a year. In the last 13 weeks, we're at 0. 26 weeks, 0. 52, 0. All the puts I had paid. I closed some off on Thursday. I took advantage of the low price of them. I thought, wow, I've made my money here. Why wait and give it back? All my puts paid. I didn't put any more puts into place because there's no premium in them. If you look at the June 90 and 89s, the June 90 pays 67 cents. That's 0.7%. The 89s pay 41 cents. That's 0.46%. So that's a percent of the strike price. 67 cents is 0.7% of $90. Being that it's 90, it's a significant capital commitment for $67 for each one that you sell, because it's 67 cents times 100, right? $67 you could make, but the capital that you have to put up, it's not worth it. There's just no volatility here. So I think it makes sense to sell puts on TLT, to continue to sell puts. It just doesn't make money. Well, I had it right. It makes sense. 67 of them and 41 cents. It makes sense. It just doesn't make dollars. There's a better way to say it. So I just don't see why I would tie up capital on this one at this point, because the price is simply just too low. Mortgage rates down to 7.02, 30-year fixed rate, down 7 basis points Thursday over Thursday. And so was the U.S. Treasury. 2 weeks in a row now that the spread has been zero. Change in spread has been zero, 264 basis points. Agency and Annaly are having a good time. 990 on agency, up 8.2% month to date. Annaly 2035 up 8.6% month to date. Had some housing data last week. National Association of Home Builders index came in at 45. It's a diffusion index, so anything under 50 is contraction. We're at 45. The previous reading was 51. Mortgage apps ending May 10th, up 0.5. Building permits for April down 3%. Housing starts up 5.7%. Month over month, that's pretty good. Wednesday and Thursday we have data here. Wednesday, existing home sales for April. Thursday, new home sales for April. For OAS, nothing to see here. Every week, nothing to see here. In fact, for two of these, really nothing to see here. ABR, let's talk about this. Had a really nice Monday. And when I saw it go up initially, the first thing I did was head to their website and look for any news releases. Then you head to the SEC and you look for anything that had been posted. And then you search the news. I found nothing. So the GameStop story was going on in the background on Bloomberg, and I thought, well, could it be a contagion effect? There was a large short interest in Arbor, and then Bloomberg started listing off some of the other stocks that had big short interest that were going up, and I thought, aha, that's what's going on. And the very next day when GameStop really started to explode in pre-market, I saw ABR really start to explode as well. I said, that's what's going on. Okay. ABR is not GameStop. ABR's financial statement, its balance sheet, is primarily financial assets. It will trade pretty much for its book value. It would be very uncommon for a company whose assets are primarily financial to trade at significant premiums above book value. It just, because I could replicate all of the assets myself without having to buy the company. There's no franchise to buy. There's no story that you can make. So it was the wrong move. Implied volatility on the calls had spiked to more than 60%. I couldn't pass it up. I knew that this would reverse because it was well above its book value per share, which is $13.02. And the only question we have to ask in an environment like this is, should ABR be trading above its book value per share or below? We think if it's trading above its book value per share, that's because the conditions are right to drag its book value per share up. The market will anticipate that and will trade at where it projects its book value per share to increase. If you think there are tougher times ahead, then it should be trading at a discount to its book value per share. And I'm sort of neutral to slightly positive on the book value per share. I think that somewhere between 13 and 13.50 probably makes sense until there's more clarity on where rates are going, but certainly not 15. Certainly not a premium that is $2 above its book value per share, and we were in the 15s. Earlier last week, I was asked what it would take for me to sell my Arbor position, and I couldn't see a situation in which I would. I like the dividend. It's 13% yield. I get paid all the time, and this company has been my friend for a very long time. I don't see myself selling it, but I did. I sold all my ABR on this. I said, okay, this is going to reverse. I know it's going to reverse. So why not hop off here and grab it $1.50, $2 cheaper? That's what I'll do. So I sold all my ABR, but I couldn't let this go. 60% implied volatility, that even if it went sideways, that implied volatility would drop to below 30. There was money to be made on the call options no matter what. There was no buyout, and even if there was a buyout, it would be extremely rare for it to trade at any significant amount above its book value per share, even on a buyout. So I sold 350 calls by Thursday, Friday. Implied volatility here was about 49%. By the time even though the price went sideways, volatility just disappeared. We got to below 40% by the end of that period of time. Just to give you an idea, this is early Thursday morning. This is 9 o'clock over here, so this is the open, and we basically just went sideways pretty much for 2 days. So I've got just to show you how volatility comes out. Here's Thursday morning. A screenshot of my positions on ABR Thursday morning, and here is Friday at the close. I had $13 puts. I only had 25 of the $13 puts, but they had nice premiums, so I had to take them, $1.75. And then I had 100. I sold 100 of the $16 calls, 120 of the $15 calls, and 130 of the $14 calls. And I had more out at higher prices. I just never got them. But I was willing to go 600, 700, 800 options short because this was just a gift. Look at the unrealized profit, just to give you an idea, because again, that went sideways, right? So on the 16 calls, 6,500, I did cover these at 20 cents. As implied volatility started dropping, those 20 cents left. I covered those at 20 cents, so when we get to Friday, you'll see I don't have the 16 calls anymore. But look at the 15 calls, 44.63. And remember now, it went sideways just with the volatility crush on this. It went to 55.18. And the $14 calls, I was up 9,174 by the time of Friday close. Again, sideways price movement. It was up 11,084. So there were two reasons why I did this. Number one is it got caught up in a short squeeze, and that wasn't going to last. Its price was pushed way above its book value per share, and its balance sheet is primarily financial assets. That's not going to last. Number two, volatility spiked. That's not going to last. It was an easy bet to make. Why? Because I have two things. I have the education and I have the experience. That's what it does for you. That's why I started this one earlier with that little discussion about how people are lured into this thing, thinking that they don't need the education behind it, that they simply just have to listen to some other people or follow along, and when somebody says here's some trading signals, off they go, or follow the herd. It doesn't work. While everybody was focusing on GameStop, I saw the opportunity in a derivative of that play, a derivative of the short squeeze, which was in ABR, and it just made a lot of sense. When I closed my $16 calls, I think my payout was around $7K, and I've got 5,500 here and 11 over here, so 23,000 for what, a couple days work. Because I really didn't start doing anything till Tuesday, and by Friday that was done. That is my return on education. Look at what happened to the puts as well. The $13 put on Thursday morning was 700, and my gain there was 759, the unrealized gain. And again, it just went sideways. Just the volatility coming out increased to 1138. I don't see myself closing any of these. I will close the $15 call probably at 20 cents or 25 cents. The $14 call still has a ways to go. I'll probably close that out at 20 or 25 cents as well when it gets there, because when you got 20 cents left on 100 of them or 120, well, basically I got 120 here, 130 here. The amount of capital that you're putting out there for 20 cents just doesn't seem to be worth it at that point. So I will probably cover those. I can't see these losing. For my long position, I did sell Arbor. I will come back in. I don't know if I'll come back in by selling puts or I'll come back in just by buying the stock, but somewhere closer to its book value per share is probably where I would drop in. We're sitting at $13.89, book value per share of $13.02. I think $13 to $13.50 is the right point, but being that I'm out, I want to get back in. I don't want to just buy it. I want to steal it. So I do have time until the next dividend. I'll wait. I don't think the short side is done on their story yet. The borrow is really expensive on this. It's like 21%. So I think it's going to be a long period of time before people or the price starts going down on short selling, because you got to pay 21%. One more thing on Arbor. I don't know if anybody had noticed, but they had filed a 30 million share shelf proposal so that they could sell up to 30 million shares at the market over time if they wanted to. And they had put that out, I think, two Fridays ago after the market closed. I don't know if anybody noticed that. They're not planning to sell shares. It's just this thing that they're holding back, saying, okay, we're approved now. We can sell up to 30 million shares. I really hope they took this advantage to sell shares. I really hope, because they would have been selling shares at $15 when their book value per share was $13. It would have automatically increased the book value per share of Arbor and gave them a lot of cash to sit on. I really hope that they took advantage and sold shares at this point. We're not going to know until the next quarterly report, but I'm going to have my eye on this. Lots of interesting things in the auto sector over the last week. And then I'm going to follow this up with copper, gold, and silver, and ending it with a report that was just released about copper. So let's start here. Mercedes, Alabama plants, 2 plants had a vote this week, rejected the UAW, 56% against. So the UAW must now wait 1 year to try again. They have 5 days to file a complaint if they feel that the company violated labor laws, which they're already saying that the company did. The company was very aggressive in fighting the union, and I guess on a daily basis made the staff watch anti-union videos. So the UAW is sort of crying foul on that. I don't know if they'll take the 5 days and file within the 5 days, or just say, well, look, let's just wait a year. Tesla, a California judge said the class action suit can go ahead. That happened last week. And it's about the misleading statements about full self-driving. There was a 2016 video put out where Musk was saying, this car is now driving itself. Later came out that it was not true, that it was not driving itself, that it was being controlled off screen. This is not going to help Tesla either. Motor Trend tried to repeat the Cybertruck Porsche test, the quarter mile. It was a commercial that Tesla had put out showing a Cybertruck racing a Porsche. And right at the very end, when the Cybertruck crosses the finish line before the Porsche, it zooms out and you see that the Cybertruck is carrying a trailer with another Porsche on it to beat the Porsche. So Motor Trend tried to replicate that, but instead of using the same Porsche, they used the slowest 911 they could find, which was a 2023 Carrera T 911, and could not replicate it. In all heats, the Porsche beat the Tesla. Now, mind you, the Cybertruck was pulling the trailer with another car on it, but that's the point. That was the point of the commercial, was that the Cybertruck did beat a faster Porsche. So they used a slower Porsche, and the Porsche still beat the Cybertruck. One of the people that was working on that commercial said, well, we didn't do a quarter mile, we did an eighth of a mile. 1/8 of a mile, because the tires on the trailer were only rated for 80 miles an hour. And we were hitting that speed already, so why take the chance? So at an eighth of a mile, we just concluded that we would win anyways. So it wasn't a quarter mile, it was an eighth of a mile. And this video was put out knowing that it was misleading. So this is going to be used by the defense to say that Tesla has a history of knowingly misleading on this one. But now this can move ahead. National Highway Traffic and Safety Association is now investigating Waymo. 17 crashes. It has level 4 robo-taxis. The National Highway Traffic and Safety Association is investigating Teslas, investigating Cruise, investigating Waymo. There is no way that you are getting nationwide robotaxi service in the U.S. while this is going on, and this is going to be the entity that is going to regulate autonomous vehicles. You're years away, I'd say even a decade or two away from having something like that. So what Tesla is planning to announce in August is not going to be what everyone thinks it is. So anybody who's forecasting major robotaxi revenue in this space, I think, is way too early. With all these investigations going on into everything, I don't see much progress, because you need these guys. You need them to say, yeah, okay, go ahead. No geofencing, no nothing. Level 4, off you go. And individuals can own these vehicles. It's not going to happen. Canada is now considering U.S.-style tariffs on Chinese-built EVs. So it's not as if you can import it into Canada and then send it into the U.S. It's like, no, we don't want that happening here. BYD is looking at setting up a factory in Mexico to avoid North American tariffs, building trucks in Mexico. They're looking at setting up a car factory in Turkey to avoid sanctions in the EU. This industry, the auto industry, is known for overcapacity. That is what we went through with the pandemic, is an anomaly. It is known for overcapacity. So expect that fight in the EV space to get worse. 2024 to date, hybrids, fastest growing segment. 6 spots in Consumer Reports list of top 10 vehicles for 2024 are hybrids. Ford is leaning into hybrids and announcing more. GM just announced that they're going to put out a hybrid instead of an EV, a plug-in hybrid. Toyota has been vindicated. You remember Toyota like a year and a half, 2 years ago, saying this EV thing is a fool's errand. And they weren't rushing into it, and they were being criticized for not making enough announcements, and they have been vindicated. The hybrid Camry, year over year, sales up 143% in Q1 2024. In 2023, hybrid sales were up 65%. EV sales were only up 46%. This is from Edmunds.com. And I have been saying this for some time, that hybrid is the way to go. Especially the plug-in hybrid. That is the better way to go. Number one, enough material in the world simply doesn't exist. You cannot go all the way to EV. And we're going to look at a report about copper that was released in May. The lead researcher from University of Michigan, which shows it is an impossibility. It is because of the number of copper mines available and what needs to be added. It is an impossibility for it to happen. It's not a matter of it won't happen. It's that it can't happen. So I've been saying that hybrid is the way to go. If we want to move somewhere, hybrid is the way to go, because the plug-in hybrid can run 40 or 50 miles without ever hitting the gas tank. For most people, in the course of a day, the driving that they do, they'd probably never hit their gas tank, but you'd never have to worry about range. because it's always there in the background. And if you reduced the battery to your 12, 13, 14 kilowatt battery, there is enough copper in the world to get that done, but not full EV. So you can go back on my channel, June 8th, I put up the video, The Ice Age is Far From Over, where I made that argument, and June 16th, I have another one, Reply to Tesla Valuation Objections, because at the end of this one, I gave some Tesla price targets. Have a look at what my forecasts were for margins and sales. And even at that time, I was being criticized for being too negative on Tesla. Turns out that my forecasts for their margins and sales were still too aggressive, even though I was being criticized of being too negative. The only thing that hasn't really followed suit so far is the price projections. Although at the end of 2022, I believe, or 2023, I think I did hit my price target when Tesla fell to under 120 bucks. I still think Tesla right now is somewhere between a $40 and $60 stock. The market, I think, will come to see that. But it was nice to see the move in the hybrids, which sort of backed up what I had done a little while ago. Let's look at that gold, copper, and silver, and then we'll look at the copper report. I don't know that you could not talk about these three. Copper, 505 close, up 28.37 year to date. February 28th, 2022 was the all-time high close on a weekly basis on copper at 518.71. In pre-market earlier in the week, it did attempt to break that, but then came right back down and then right back up. So I think it's just a matter of time, not if, but when copper starts printing new all-time highs. Freeport year-to-date up 27.7%. COPX year-to-date up 39%. Look at gold, all-time high closing, 24.17. Never been higher. All-time high closing, 14.42 year-to-date. And silver, 31.775, all-time high, long way to go, 48.70, a long way to go before you hit the all-time high, but you are at an 11-year high, 29.25% year-to-date. If we look at Newmont, up 6.04% year-to-date, gold's up 14, Newmont's only up 6, and Pan American Silver up 34% year-to-date. Silver's up 30%. You could say that's sort of priced in. You got copper up 28%, Freeport up 27%. You could say that's sort of priced in, but Newmont still might have a way to go. Freeport produces copper and a lot of gold, and gold's at an all-time high. Newmont produces gold and a lot of copper, and copper is heading up to its all-time high. Both of these, both Freeport and Newmont, their primary and their secondary metals are both breaking out at the same time. Is there a case? It's hard to make a case with gold and silver because that can be bought for investment purposes. Copper is really an industrial product. You don't really buy copper and put it on the shelf somewhere and say, you know, have you seen my copper bars? They're really nice. So is there any reason to believe that copper can still continue? Let's look at this report. Okay, here's the title of the report, Copper Mining and Vehicle Electrification, and it was commissioned by the International Energy Forum, May 2024, so it is fresh off the presses. Now look at two exhibits. First one up here is in two panels, A and B, and then we have a grid down here. Let's just look at A. I'll explain what we're looking at. Let's look at the teal line. This is a current mine output. And you see the black dotted line here, that is the forecast. So this is what is forecasted based on just the current mines in existence now. This number down here, Q 2018 at 784 million tons. This is Q 2050, 1689. You got 2086 and 6598. That is the cumulative amount of copper mined to date. You need that to determine how much is going to be recycled, because recycling is a function of all of the copper that exists, not just the copper produced per year. And that is what the green line is the forecast, the incremental forecast for recycling. So how we would read this, let's look at 2050, is you draw a line up, there's your production. The extra amount here above production, that incremental amount, is what can be gained from recycling. So if you add the two together, you get to refinery output, which by 2050 is 50. This is current production. This over here is saying, well, how much would we need under different scenarios? So we can see the 2050 line over here. Here's the 2035 line. Let's just put a dot up here. If we find 2035, or about here, if you bring it up to refinery output, you are at about 40, which would be somewhere here. But we'll just bring it up to here. And here is 2050. 2050, we could see, we've already drawn that out, is at 50. For the baseline scenario, that's just assuming that we produce ice. We don't run out of copper at all based on current production. If we move to hybrid, there it is right there, we're still okay. Even if you move to EV and then upgrade the grid, because the more EVs you add, the more you're transferring the powering of the vehicle from the gas station to the utility. And this is just assuming that EV supply will grow in line with demand, and it's not going to be forced on you. It's your choice whether to take it or not. Net zero by 2050, this is regulatory decisions. So for instance, if you look at EPA's emission standards and NHTSA's, that's the National Highway Traffic and Safety Association, look at their fuel efficiency standards for 2027 to 2032. The traditional auto companies have no choice but to put EVs on the market so that on a fleet-wide basis they meet the fuel efficiency standards and the emission standards. They have no choice. So the production, the supply of EVs in a lot of jurisdictions in Europe, in China, in Brazil, in the US are being driven from a regulatory perspective, not from a business model perspective. From a business model perspective, it makes sense to do the EVs even if you lose money on them, because the fines you would get would be bigger. It's cheaper to lose money on an EV than to pay the fine, so you're going to have price wars for some time in the EV space. If you try to actually meet all the regulations, net zero by 2050, this is the trajectory of copper that you would need. Here is the supply. Notice the gap. You're not going to make it. Even by 2050, you're not going to make it. So it's not a question of, we're not going to see it. It's you simply cannot see it. Now, this is just current production and the gap in current production. Down here, it says, okay, well, what do we need to meet it? To meet all these scenarios? Baseline scenario, we're starting at 260,000 tons here. The 260 million mined above the 2018 line. You'd need another 260 million tons. New mine production in 2050, you need 16.3 million more tons, which is 35 new mines, or 1.1 new mines per year to meet that. Now, for these new mines per year, it assumes production is at the average of the top 10 mines, something like 109 or 136, I forget the number, mines, copper mines in operation. If you take the top 10 mines, and look at their average production, each mine coming on each year would have to have production at the average of the top 10. So there's your baseline. If you go to hybrid, you need 1.2 of these mines per year. To meet net zero, look at the increase that you need here. New mines, you'd have to add 194. You'd have to have 194 new mines by 2050. You'd have to be adding 6 of these per year, and each one of them would have to have the average production of the top 10 that exists today. Simply can't happen. It simply doesn't exist. That cannot happen. So going back to the video that I had made, the ice age is going to be with us for a very long time. The ice age is far from over, and our real solution in the interim, if we're going to make it and not cause copper prices to go to $6, $7, $8, $9, $10, $20, $30 a pound, is hybrid. If we continue on with this war on internal combustion, with the 2035 deadline for no more internal combustion, if the regulators keep pushing emissions and fuel efficiency standards to the point where auto companies have no choice but to put EVs out, EVs will become so unaffordable because you're not just going to hit a wall of supply in copper, which is very obvious from this. You're going to hit a wall of supply in a whole bunch of other materials, and the vehicle will be unaffordable. We've already seen some jurisdictions dial back their requirements, saying, oh, okay, well, maybe 2030 was too much, maybe 2035 is too, okay, let's go to 2040. You're already seeing that being dialed back. I expect that to see that being dialed back even more. If not, copper keeps going. Copper prices keep going because you have another thing going on at the same time, which is the increase in AI, which is power, a big power user. So grids are going to have to be upgraded, and it is a move more and more towards renewable types of energy, which require more copper. An electric vehicle, by the way, requires almost 4 to 5 times the amount of copper as a normal vehicle, going from 40 pounds sometimes up to 200 pounds of copper in an electric vehicle. If you're upgrading your grid for AI, and you have to upgrade your grid for EVs at the same time, copper doesn't exist. It doesn't exist. Something's going to have to be squeezed out, even if the price goes to $100 a pound for copper. It still doesn't exist. Well, I shouldn't say that. At $100 a pound, you probably, let's go down over to here, the possible and probable. Probable are your reserves, possible are your resources. And resources have been proven to exist, they're just not economically feasible. I guess at $100 a pound, you would have a hell of a lot more reserves. So, let's just change something here. Either you have to find this many mines per year, or the price of copper would have to go up so much that a lot of those resources then become economically feasible to mine. So is copper going to continue on from here? I've been saying that for some time, that I think copper eventually will see $6 a pound. Seems to happen really fast. I thought that this would happen over a period of time, maybe out to 2026, but here we are, over $5, and you have momentum that's starting to build because the more people that talk about it, the more attention it gets. Let's jump back to the beginning of the video where we talked about attention focused investing. It's going to drag more of that in. You have momentum and I think a good story behind it of why it could continue. So yeah, copper I think probably continues from here. Okay, here is the report. Let's just read the abstract and the conclusion. By the way, when I did my PhD, you have to read so many papers. I just got sick and tired of it at some point, and that's all I did, abstracts and conclusions. I didn't care about the rest because the lit review is almost the same for every paper. The methodology, only if I'm looking to replicate something would I read the methodology. So abstracts and conclusions, that's all I cared about. Electric vehicles require substantially more copper and other metals than conventional internal combustion engine vehicles. For example, manufacture of an ICE automobile requires 24 kilograms of copper, whereas manufacture of an EV requires 60 kilograms. Many have expressed concern that the lack of critical mineral resources may not allow full electrification of the global vehicle transportation fleet, and the vehicle electrification resource demand is just a small part of that needed for the transition. By displaying both demand and mine production in full historical context, we show that copper resources are available. No, those are not reserves now, those are resources. Resources are available, but 100% manufacture of EVs by 2035 requires unprecedented rates of mine production. The 100% EV target not only requires significant extra copper for battery manufacture, but also more copper for grid upgrades to support charging, while hybrid electric vehicles do not require extra grid capacity. Under today's policy settings for copper mining, it is highly unlikely that there will be sufficient additional new mines to achieve 100% EV by 2035. Policymakers might consider changing the vehicle electrification goal from 100% EV to 100% hybrid manufacture by 2035. This would allow for future output of existing new copper mines to be used for the developing world to catch up with the developed world in electrification. Life cycle emissions for battery electric vehicles compared with hybrid electric vehicles are comparable with each other. Mining must be recognized as essential, and exploration and responsible copper mine development strongly encouraged. Okay, for recommendations, we'll just read the first paragraph here. For the reasons presented above, it is evident that attention needs to be paid to managing the copper demands of electrification and the transition to renewable energy sources. An aspect of Figure 1b not yet emphasized is that there is remarkably little difference between the amount of copper needed to manufacture hybrid electric rather than ICE vehicles. Hybrid electric vehicles require 29 kilograms of copper compared to 24 kilograms for an ICE vehicle. It would therefore be judicious to aim for a transition to the 100% manufacture of hybrid electric vehicles by 2035, rather than transitioning to the 100% manufacture of battery electric vehicles, which require 60 kilograms. The copper required for this transition is only slightly above baseline and does not require major grid improvements. Hybrid electric vehicles could have almost as large an impact on reducing CO2 emissions and city pollution, and the likelihood of the copper required for the manufacture being available is much greater. Life cycle emissions for battery electric vehicles compared with hybrid electric vehicles are comparable with each other, with some variations depending on the model of the vehicle. This is not a perfect solution, but it is a much more resource realistic one. Reducing the critical minerals in large battery banks should continue to be sought. Sustainable recycling should be strongly encouraged. Mining could meet a steady copper demand pull with environmentally sustainable mining practices, but mining might not be able to meet too sudden and substantial demand increase, and the economic and human welfare consequences of this failure could be substantial. Okay, closing SPX 5303, forward four-quarter operating earnings, LSEG 252.93, call it unchanged from the week before. S&P Global 249.95, again, probably call that unchanged. So we are now 21 times forward earnings, up from 20.76. Surprise factor on earnings still 8.2%. So if we adjust our forecast for the surprise factor, we're at 19.5 times forward earnings versus 19.16. So keep in mind, to get this 19, these numbers have to happen along with this surprise factor. Implied volatility pretty much disappearing to the point where it's really not worth selling puts on the S&P. We have an all-time high closing of 529.78 on May 15th. That's 1.3% above the last all-time high closing. I think we've set, was it 24 all-time high I'll say it, closings for 2024, something like that. Reading the financial news over the weekend from a lot of different sources, the general consensus seems to be 1 or 2 rate cuts in 2024. And the S&P 500 continuing to hit new highs throughout the summer. So rate cuts have dropped, 1 or 2 rate cuts, but that the market will continue to go up on that. That seems to be the general consensus. If we look at a couple of ratios, there's a fear-greed index and there's a bull-bear ratio. The fear-greed index is at greed level. which is at 65. How it works is 45 to 55 is considered normal. 55 to 75 is considered greed, and anything above 75 is considered excessive greed. And 25 to 45 is considered fear. 0 to 25 is considered excessive fear. We're sitting at 65. In other words, what's driving the market? Greed. Looking at the bull-bear ratio, I think it is 56.5% is bullish. And normal conditions are 45% bullish, 35% bearish, and 20% neutral. And we are at 56.5%. These are contrarian indicators that when everyone's bullish, that's the time that you really need to be concerned. One thing that jumped out to me on the weekend as I was reading is everybody's bullish. I couldn't find, other than the usual suspects, the usual 2 or 3 names that you see that, oh well, they're always screaming that the market is going to drop. I just ignore those. But generally, overall, it was bullish. Normally, each weekend you read it, you find some good commentary about why we should be concerned about this, or why we should be concerned about that, or how this is going to affect earnings, or how this is going to affect this line, this expense line item. Nothing. That was all absent. So that seems a little bit troubling if we think about it from a contrarian perspective. That nothing is of concern at this point. We do have some earnings coming up this week. LSEG and Sector SPDR, converging at 17, SPGlobal at 13. Again, I think I'm going to start investing in a service that has an economic calendar that is right. I don't see how hard this can be. What do we got here? Tuesday, Lowe's and AutoZone. In terms of retail, we got some more retail here on Wednesday, Target and TJX, and then Thursday you have Dollar Tree and Ross Stores. A lot of retail this week. The big one, let's just get right to it. Nvidia is going to be the big one, and they had a price run up. I think they're over $900. The last 2 times they reported, they had sell-offs into the report, and the report came out good, and then they rallied from there. Now they're rallying in front of the report in anticipation of it being good. It has, by rallying in front of it, it has a higher chance of disappointing relative to its price, because it could rally and price everything in, and then when the news comes out, if it's not even better than what is expected, it's expected that the outcome will be better. If it rallies in front of it, it's going to have to be better than better. You have a higher probability of a sell-off on that one, but I don't know that it would be a sustained sell-off. This is still a big open question with Nvidia. Is there a multi-year, even a decade-long build-out for where Nvidia sits? Or is this build-out going to be 5, 6, 7 quarters, and then once there's enough capacity, that's pretty much it? Is this the internet all over again, where everyone thinks it's a multi-decade build-out, or is there going to be so much overcapacity that when all of these startup firms fail, it's like, well, what do we do with all this capacity now? It's still an open question. I really don't know, but I don't know that there's anything that happened in the previous quarter where I would say, oh, the story's over. It's I think a difficult thing to predict, especially if you're not in that space. It's a very difficult thing to predict, but I think it's going to be like everything else in history, where money flowed into something, where there was an infrastructure build out in something. Almost every single time there's been a rush into something, it has been followed by overcapacity and a bust. So is overcapacity and a bust in Nvidia's future? Yeah, yes it is. When? I don't know, but yes it is in its future. I just don't know when. And that'll take us to the end of this week.